Volume profile is the most powerful underused tool in retail trading. Most traders add it to their chart, see the colorful histogram, and don't really know what to do with it. The framework comes from auction theory. Prices where significant volume traded are prices the market accepted as fair value. Prices with little volume are prices the market rejected. That single distinction turns volume profile from decoration into a structural map. Today, the three components, point of control, value area, naked POCs, what each one means, and how they combine into the cleanest structural levels available on any chart. Here are the three levels. 1. POC, point of control. The single price where the most volume traded during the session. That's the price the market spent the most time at, where the most participants positioned, where the strongest agreement on fair value formed. POCs are defended on retests. 2. Value area. The range that contains roughly 68% of the session's volume, typically POC plus and -1 standard deviation. Inside the value area is fair, outside is rejection. 3. Naked POC. A prior session's POC that has not been retested. Price tends to return to naked POCs, they act as magnets. These three together form a structural map that's dramatically more reliable than horizontal lines drawn by eye. Watch this in a synthetic chart. A trader draws a horizontal at 106 because price touched it twice. They short at the touch expecting rejection. Price slices through to 110 and the position is stopped. What they didn't notice, the session's POC was at 108, the price where the most volume actually traded. That was the structural level, backed by real participation, not by their eye. Their drawn line had no volume confluence and got ignored by the market. The POC, sitting in plain sight on the volume profile, was the level worth respecting. The trader was reading the chart with the wrong tool. Here's the rule. Use the volume profile to identify the real levels, POC, value area high, value area low, and any naked POCs from prior sessions. These are the structural levels that have actual participants behind them. Drawn horizontal lines are decoration in comparison. When a chart pattern coincides with a volume profile level, say a breakout that aligns with a naked POC, you have triple confluence and a high probability setup. When you're trading levels with no volume backing, you're guessing where the rest of the market doesn't agree with you. Now with the volume profile read correctly, the session POC at 109, heavy volume node defended on multiple retests. A naked POC from 3 sessions ago at 112, price hadn't returned there yet. Trader uses both long entries near the current POC with confluence support, target the naked POC as the magnet. Price extends to the naked POC, completes the rotation, and the magnet is filled. Same trader, same chart pattern, but now reading the actual structural levels instead of drawn ones. The math improves dramatically because the levels are backed by participants, not by lines. In practice, enable a volume profile on every chart by default. Daily time frame for swing traders, session profile for day traders. The POC is your most important level, the price the market consensus accepts. Value area edges are your secondary structure. Naked POCs are your magnets. Combine those with price action and you have a structural map that retail traders without volume profile literally cannot see. The profile is the chart's voting record on which prices matter. Read it and the rest of the chart starts making sense. So, volume profile turns the chart into a structural map based on actual participation rather than drawn lines. POC marks the most traded price, usually defended. Value area defines fair value zones. Naked POCs from prior sessions act as magnets. Use all three together and your level reading dramatically improves. The volume profile is the most powerful underused tool in retail trading and it's free. Subscribe for the full method and trade your own plan. Education, not financial advice.